Today, just a couple of housekeeping items. So we're going to be recording today's session. Your microphones and cameras have been disabled for everyone except the panelists that we have on today that you can see on your screens. If you have any questions, please use the chat function, and we're going to save the questions until the end. Unless they kind of make sense into the questions that we're asking, then we'll incorporate them. But yeah, thank you. And let's go ahead and get started. So we've got Andre, Andy, and Anita on. Can you please introduce yourselves and give a brief overview of your roles? Let's start with Andre, and then we'll get to Anita and Andy.
Absolutely. Sarah, thank you so much for you and SVB and IDB for participating in this with us and hosting actually this panel. So my name is Andre Tilly. I'm a corporate partner here at Foley and Lardner. We are a full shop one-stop firm. We are a U.S. law firm that does from transactional litigation, immigration, work, tax, 1,400 lawyers in 25 offices in the U.S. We have presence in Latin America, specifically Mexico City. I myself focus my practice on venture capital and M&A, and with a specific focus on Latin America because of my background. I'm American born with Brazilian parents, practiced law in Brazil for about 10 years before I moved back to the US. So obviously this particular talk has a special place in my heart when we're talking about funding Latin America, be able to develop the ecosystem further and further and further. And I think, as we were discussing before, this panel on venture debt could not be more timely given where we are economically and what's happening in the markets right now. So that's my 30-second elevator pitch.
Anita?
Hi, everybody. Anita Fiore here. I'm a lead investment officer at IDB Lab, which is the laboratory for innovation of the IDB Group, the Inter-American Development Bank Group. I sit in Washington, D.C. in headquarters, and my role is to supervise and design venture capital funds. I usually joke within the four verticals: everything that is blue tech, everything that is green tech, everything that is black and brown, like Afro-descendants, and everything that is pink that has to do with women. But I'm also a venture debt specialist at IDB Lab, so great to be here.
Thank you. And Andy?
Thanks, Sarah. Hi, everybody. My name is Andy Tsao. I'm a managing director at Silicon Valley Bank and head of our Global Gateway business that's been spending time in new and emerging technology hubs around the world, including Latin America, where we've been doing biz dev for over a decade now. And it's been an amazing journey watching the growth of the ecosystem. I'd like to start by thanking Andre and Foley for being a partner with us on the webinar today, and Anita and IDB as well as for not only the webinar, but also for being a partner with us on our venture debt fund, which we'll talk about a little bit later. And thank you, Sarah, for moderating today.
Thank you. And for everyone's background, so Sarah Rona, I work at SVB with Andy. I'm on the Global Gateway team. I head up Australia and New Zealand, as well as our global channel partnerships. So partnerships with the likes of Anita and Andre, law firms and accelerators and other banks. So again, let's go ahead and get started. We've got a ton of questions. I will repeat, if you do have anything, feel free to add it into the chat. And let's go ahead and get started. So Andy, the first question is for you. Can you explain to us what venture debt is and how does it work?
Sure, Sarah. So venture debt financing is essentially debt financing for venture-backed tech and innovation-based businesses. It is something that's been around for more than 30 years in the U.S. Silicon Valley Bank was one of the original pioneers of creating what is known as venture debt today. But in the U.S., it's a relatively mature industry today, as you might guess, given that it's been around for a couple of decades. If you look at the numbers, about $34 billion of venture debt was deployed last year in the U.S., and that was in 2021 relative to, over 300 billion of equity. So it is, that's about 10% of the total funding provided last year. So again, in places like the Bay Area or New York, Boston, many venture-backed companies take advantage of getting venture debt, which augments, again, a loan that augments the equity financing that you've raised and effectively gives you more capital to accomplish the objectives that you're trying to meet. And whether that's, hitting a key milestone, and then that allows you to go back to not only give you more time to meet your milestone, but hopefully once you do that, you can go back and raise funding at a better valuation. And so that's sort of the classic value proposition of venture debt, is to give you a little bit more cash runway to help you accomplish your objectives. So I'll stop there. It's sort of typical. It's a relatively simple product, being a senior loan most typically, and considered senior debt to a startup company.
Thank you. And Andre, Nita, if you have anything that you wanted to add, feel free to. Otherwise, we can get to the next question. So I guess my next one is for Andre. So when is the right time to raise venture debt, and when should a company avoid venture debt? I guess from a legal perspective.
Right. So I'll piggyback on what Andy just said, right? So he mentioned that typically you would have venture debt deployed as more capital to the company after the company has done an equity financing. So here in the US, where this product is very well known, as Andy mentioned, it's been around for decades, we tend to recommend our clients to listen. You close your Series A, which is your first equity financing, where you have institutional investors that are known to the lender, right, which is part of the assessment, and you have a company that just got cash in. This is potentially, if you need to hit milestones, and if you need to get that bridge, as Andy mentioned, to get into a higher valuation for purposes of your next equity round, that will be the time. I think when we're talking about Latin America, it will be great to hear Anita's and Andy's perspective on this, is that because it's relatively newer product and where they are, it sounds like that the market there is a little bit more prepared to have this in a little bit more late stage companies. So companies that are at the A's and the B's and the C's and the D's, as opposed to the A's. But we would definitely recommend any client that close their A to actually explore this potential product, even if it is, oh, you're not ready for it because you're not getting what the lenders are looking for right now. You don't have it right now, but explore the product because it could give you a source of capital that would be cheaper for you. And we can talk about that too, but it will be cheaper for you from a dilution perspective in terms of your cap table, and it can accommodate more cash coming into your company so that you can develop whatever is your product or your solution. And sorry, so to the short answer on not to get, I think when you're too early stage, just to answer your question, that will be the time. Like, it makes no sense for you to try to raise venture debt when you don't have a venture-backed company with a robust investor and you have done an actual solid equity round before.
Got it. Thank you. Oh, Andy, go ahead.
I was going to say, Anita, do you want to add anything? Otherwise, I could chime into what Andre's.
No, I think it's right on. I completely agree with Andre for it.
Thank you. I agree with Andre in terms of for the listeners to keep in mind that we've been mostly talking about venture debt from a U.S. lens, so 100% that venture debt in Latin America is a relatively new form of financing, and there have been a couple of players around for a couple of years now. SVB, we'll talk about our fund a little bit later, but we got going in 2020. So again, it's a relatively new product, and so the terms and availability are different in LATAM than they would be in the US. Our fund in particular is geared for later stage companies, exactly to Andre's point. Sort of maybe just addressing the elephant in the room, if you will, right now, that we're going through a market correction, as people on the webinar certainly know. And so the notion of debt financing seems really attractive because it's another way to finance your business, and it's non-dilutive, as Andre said. So just be careful at this point in terms of, when you take it on. As Andre said, typically it's done right after you've closed your funding round, and so the longer you wait, it becomes truly a bridge loan. And so during those periods of time, that venture debt becomes, harder to obtain. So like anything else, if you start early, you give yourself more time, and you can, you can negotiate better terms for yourself. Obviously there is some level of underwriting to companies, the same way equity investors would look at a company. And so if you're in a situation where you're having a real hard time obtaining equity financing, you might get a similar reaction today, given the market conditions, to a lender who's looking at the business too. So I'll stop there, but it's just to your point on when not to get it. Those are a few clues.
And one additional comment to piggyback what Andy just mentioned, which is be mindful as well that if you're looking for venture debt as you're doing your equity round, that you allow yourself when you're negotiating your documents with your investors to be able to have that wiggle room to do so. Otherwise, there are going to be areas where either you're going to have to get consent to be able to do your venture debt, which might not be a great position if you're an entrepreneur and you want to do that without investor consent, or you may trigger potentially anti-dilution provisions depending on if there is a kicker, meaning some equity small portion that the lender may get through a warrant here in the US and other types of instruments in LATAM. So be mindful that if you're an entrepreneur and you're thinking about doing venture debt as you're doing an equity round, that you leave yourself enough room for you to be able to do so within your financing documents.
Thank you, Andre. That's actually a really good segue into my next question, which does focus on Latin America. So Anita, specific to LATAM, how do you think that debt financing can help startups, and what are the benefits to the wider ecosystem, in your opinion?
Yeah, super timely question, right, Sarah? I think, well, as most of you that have followed us here know, I mean, I'm a big fan of venture debt. I always thought it was a great complement to venture capital rounds. It was true 2 years ago, 3 years ago, before the pandemic, and it's super true now, once again, yet again. In LATAM, I think we are seeing a natural, in terms of total capital flows, private capital flows, we are still seeing a very strong first quarter in 2022 in LATAM, but most of it is driven by what we call private equity, which is usually Series B and above. Venture capital is seeing a decline of around, depending on the country, between 20 and 30%. So which is important for entrepreneurs in the region, because now, yes, closing a round is going to take longer than you expected, and it will be harder for you to close your round with full equity, depending on how much you want to raise. So I think it's the perfect scenario for a venture debt type of scenario. I usually work with startups that are in the earlier stages, not as ideal as Series B and above. But again, in Latin America, this whole thing of series is becoming so confusing. I think I see ticket sizes of Series A that are super large that I would consider Series B, and the other way around, the guys in the Series B and the ticket size is not that large. So, but depending on where you are, I think the message that I'd like to leave, I think why it's important for Latin, I think right now it's important for those entrepreneurs who want to continue their growth path, despite of what the investors are telling them right now. It's not a good product to increase profitability. Not at all. It's a product to complement your round and continue your growth path without diluting yourself. So I think it's a very interesting product for LATAM. Again, I always believed in it, and unfortunately, I think it's coming in a very, how can I say, not as happy time as we would like it to be. But again, I think now I believe the LATAM market is finally going to understand what the product is about and use it wisely. That's how I see venture debt right now in the region.
Yeah, I mean, to Anita's point, we launched our Latin Growth Lending Fund 2 years ago, and we've been deploying it through with a few deals we've completed now, but it's, we thought we would be doing it at a faster rate. But in an environment where last year in LATAM, we had, almost $16 billion of equity invested, nearly, 4x the 2020. So there's so much equity available that people sort of, it's just easier for folks to raise equity, and venture debt is still a relatively new product in the region. And so to your point, Anita, I think we're both getting a lot of queries now today from our clients about, hey, what is venture debt? How does it work? And we'd be delighted to have those conversations with you today.
Yes, correct.
Thank you, Andy. I actually wanted to segue into another question about our process for venture debt, but I'm going to hold off because I think this might be more relevant. So if you look at venture debt in terms of other forms of credit, in your opinion, what types of companies, stage and sector speaking, are the best candidates for venture debt? Because some of them might not be, right? So which ones do you think would be?
Yeah, so Sarah, first of all, as others have already indicated, stage-wise, let me start with the U.S. first. Traditionally, you can access venture debt at Series A financing. Over the last year or two, actually in the U.S. market, because seed rounds have gotten so large that some lenders, including Silicon Valley Bank, have started to consider venture debt at the seed stage. In Latin America, it's generally, as Anita indicated, closer to sort of at least Series A, probably more like Series B. Companies are scaling and looking for financing to help them grow, exactly as Anita was recommending. So how is venture debt different from other forms of debt? And so, if you go to your your typical bank, let's pick one, Santander or Bradesco, they offer things like invoice discounting, where they're lending against specific assets. They may give you an overdraft facility that works with your bank account. And again, those are very, the access to those facilities are generally at the discretion of the bank, and they are dependent on the level of assets that you have at any given point in time. A venture debt loan is generally, and again, I'm going to talk more through a U.S. lens, a multi-year facility, kind of typically 3 years in terms of repayment. You generally have 6 to 9 months to be able to draw the facility down, and then that loan amortizes over a couple of years' time. It's a little bit more flexible in terms of the use of the proceeds can be used for anything. You could use it for working capital. You could use it for purchasing assets, and in terms of financial covenants or tracking the business, generally they're a little bit more flexible. Again, designed for startup companies rather than traditional businesses with a lot of predictable cash flow. In terms of pricing, you would expect to pay obviously an interest rate. You'd be paying typically some setup fees, and then there's almost always some kind of equity component that's again usually in the form of options or warrants that the lender has as an equity kicker, if you will, to be able to participate in some of the upside of the company should that happen. Our Latin Growth Lending Fund that we have with IDB and Partners for Growth is again geared for later stage companies, and I should say that they are custom lenders in the sense that they'll look at your business. It's not like one size fits all. It's not like a particular cookie cutter approach. They will look at your business and work with the entrepreneur to determine what it is they need. If it's a more of a flexible line of credit, fine. If it's that they can draw up and down on. If it's a multi-year loan, great. If it's a loan that converts at some point or some portion, they're happy to talk about that as well. So we have a pretty creative and flexible approach that we take with later stage companies in Latin America.
I just would like to complement. I think for LATAM everything is very, very similar. I think it's a super flexible instrument, as Andy said. I think there's no specific vertical that Now, I have to say, another elephant in the room. I think the SaaS companies, the software as a service companies, usually are a very good client for venture debt. They are growing very fast. They scale very fast. They have recurring revenues already that allow the venture debt lender to better protect the cash flows, and as a consequence, you may get better pricing. So I think SaaS companies are good. I mean, many others are, but SaaS are like the ideal type of companies in my view. I mean, at IDB, our terms, I mean, because we usually, the typical venture debt for Series B and above, we are doing it with Silicon Valley Bank, right? Through the fund. We do direct venture debt for companies that are in earlier stages, but these are very specific. Remember, IDB is an impact investor. So usually it has to have a very strong environmental or social impact that the product or service of that company is trying to solve, to deploy. So our thesis is a little bit different. Venture debt is now not our bread and butter at the IDB. Just like Silicon Valley Bank, we look at other types of companies. But yeah, I think it's a very interesting, and our role, I think right now, more than deploying venture debt, frankly, is to educate the market about venture debt. I think that's the most important thing the IDB has to do right now.
Sarah, can I actually ask a question? Because I think we have another elephant in the room for Latin American companies, and if
So many elephants today.
Yeah, there are several. So I think Latin American markets are afraid of two things historically because of the economic history of all. Well, Latin America is a very broad brush, but typically you would say which are interest rates, which typically tend to be unpayable depending on the type of local loan that you're getting. And the second one is exchange rates. So I guess my question is, does your fund, Andy, do you work where you actually lending and you're wiring through the US, which is going to be $1, but do you offer the product that you're doing in local currency, one, which I think it's a huge advantage because they're not running the exchange rate, and then two, if you are doing so, in which countries are you actually placing those products that make sense to you?
Yeah, thanks, Andre. Yeah, and for sure, we've seen a lot of FX volatility if you just look at the real dollar exchange rate over the last couple of years, right? It is the fund we've raised with IDB and Partners for Growth is a $30 million, it is a dollar denominated fund. That being said, we are able to lend in local currency. Now, when we do that, we hedge on two ends, both we hedge as a lender, and then we ask the company to hedge on their side as well. And so there is it takes the some of the foreign exchange volatility out of it, but it could obviously add some cost to the transaction as you look at the sort of the cost of putting those hedges into place.
Which is a great thing because it creates certainty at least as to what the company's going to incur, and if the dollar goes to now it's 5-1 for the Brazilian real and it goes to 10, they're hedged and therefore protected.
100%.
That's great. Sorry, Sarah.
Yeah, no worries. So I know everyone's been talking about the Latin American Growth Fund, so I wanted to kind of back up a little bit. This question is for Anita, and obviously everyone else feel free to chime in. But can you talk a little bit more about your partnership with SVB and what were the incentives of actually creating the fund in partnership with PFG as well?
Thank you. Yeah, well, as I don't know if most people know, but the InterAmerican Development Bank is a public development bank, multilateral development bank, where we have shareholders, which are representatives of 48 different countries. So our role is not only, again, to fund the ecosystem, but mainly is to provide knowledge and connections to the ecosystem, especially now there's so much more developed than it was 10 years ago. So, you know, Andy and I have a joke. We have been dating for a long time, the IDB and Silicon Valley Bank.
This is being recorded, by the way.
Yeah, it's recorded. That's fine. Don't worry. My bosses are gonna love it. But but we have, you know, the IDB Silicon Valley Bank. We have been dating for a long time, and my struggle. I mean, not struggle, but it was my process of learning. Remember, Andy? I was like, Andy, but we have to do it for earlier stages. And you were like, no, Anita, you don't understand. It's not the right product for earlier stages. And so he decided to abandon me, and he decided to start flirting with IDB Invest, my older brother, that finances larger companies, Series B and above. I'm joking here, but then I thought, well, maybe so. I think it's important for you to, you know, talk to IDB Invest that is looking for alternatives as well. I mean, it's part of the group. You also, so our role, Sarah, when we married Silicon Valley Bank was, first of all, to bring the product for the first time to the region, right? So, and make the region get acquainted with the product, learn about how it works. Because again, as you see, the market's developing, I mean, the Latin market is developing very fast. And now we didn't anticipate it was gonna come like that in the form of a post-pandemic crisis. But now we see, like, we are very happy that we married 3 years ago, and now, you know, we deployed, I think we have 3 approvals, right, Andy, in the fund. And now I see more and more demand for that fund. So we partnered with Silicon Valley Bank because it's part of the development stage of the LATAM ecosystem. The ecosystem has to learn on how to go about venture debt and make use of this product as the market develops. And SVB is the perfect partner for that, I believe.
Wow, we love to hear that. Andy and Andrew, did you have anything else to add to that?
I have to say to Anita, of course, that we're happily married now. But I
have
mean,
3 kids, 3 investments.
Hopefully many more coming, right? You know, I think to Anita's point, the bank has been, Silicon Valley Bank is the bank for the innovation economy in the US, and we've spent the better part of, well, more than a decade doing business development in Latin America. And as Anita was saying, we saw the ecosystem growing and maturing and different capital gaps being filled. And one that was obvious that the bank, you know, is quite expert in was providing that debt financing layer for entrepreneurs to be able to have an alternative source of capital to go alongside their equity finance. And so in Silicon Valley Bank's mission of helping entrepreneurs to be more successful and working with IDB and Partners for Growth was, you know, a perfect marriage to be able to introduce venture debt to the region and help the entrepreneurs of Latin America continue to be successful.
Thank you, Andy. All right, so I'm going to get to a serious question, a less marriage inclined question. So this one's for you, Andre. So from a legal perspective, actually, I guess this is a good marriage question as well. We're including the law firm. So maybe this is more of like the prenup or the NDA sort of questions. But so yeah, from a legal perspective, how difficult is it to document a venture loan in, you know, let's say Brazil or Mexico? And then how long does it take? And again, if you can give some some ballpark figures around cost, just for the audience to know what to anticipate.
Sure. I mean, I think Andy and Anita can speak about closing costs and fees that they charge in the fund. I think, so let's take a step back. Here in the US, typically you would have a loan agreement that's going to document if it's a revolving credit line, a lump sum disbursement. You're going to have a security agreement that's going to talk about the collateral that's going to be given. And I think we actually have a question that I'm happy to address on the Q&A about collateral. And then if there are multiple creditors, sometimes you have what we call a subordination agreement. So meaning where the creditors are going to negotiate who is the senior creditor, who is the junior, what happens if the junior creditor pulls the plug and calls in the debt, and what happens with the collateral and the debt of the senior creditor. In LATAM, you have many different flavors, and depending if you're using a potential local player, which I think have they're trying to do it in a way, or if you're using it sort of like a player like SVB. So locally, for example, in Brazil, you can go as simple as using a CCB, which is a Cédula de Crédito Bancário, which is basically a document that says, you owe me this amount of money, this is the time that you need to pay. You have certain covenants, which is basically things that the company cannot do while the loan is outstanding. Or you can go as far out to the deep end of doing a full-blown debenture that needs to be filed and registered, and that takes a little bit more time. It becomes public, obviously. And so the timing of that, I think it depends on how long it takes to negotiate. And I think a lot here, it comes also down to who is your lender, and how much expertise does the lender have in negotiating and putting that product in place? Because if your lender has not done it and they're skeptical about their guarantees they're going to get, or they're skeptical about the risk that they're taking, then you may get harsher terms on what it's been required from you. And to answer the collateral question, I think in the US, the typical venture debt will get a collateral over everything. And then before people spook out, I'm going to explain how that typically plays out. But typically, there is a blanket collateral. You file what we call a UCC1 here, where it gives publicity to everyone that company has its receivables, its IP, typically equipment, and all of it. It becomes a first sort of line of defense if the company has a problem and the creditor needs to collect on that amount. In LATAM, and it'll be also great to hear from Andy and Anita how they're structuring, I've seen it in two different ways. I've seen it that being done at the operating company level, which is as a collateral over all the assets, which typically for the creditor, there are certain challenges there, because I think in Latin American countries, it's harder, legally speaking, for the creditors to be able to access that. It takes a long time going through the process, as opposed to here in the US, which the creditor can get access to that pretty quickly. Now, when the other structure that I've seen is, because normally venture-backed companies that got money from institutional investors, they have already flipped their structure to the US or to some other common law country. Then you had creditors actually asking for a collateral of the equity that parent company holds on the operating company. So that, again, it's a full collateral. And now the reason why I say people not to spook out is, and this is one thing I love to people to leave this seminar or this webinar in the back of the mind, is that venture debt creditors are not there to take your assets. They're not there to do that. They don't have the incentive. They don't want to operate your business. They don't want to do that. They basically want it to, so they have some guarantee if they're going to put a collateral requirement in place. But normally, it just gives them the ability to sit down with the company and say, listen, let's work this out. The company's going through financial problems. My money needs to be the first money out before you pay any shareholders. So let's walk through this in a way that everybody can get a good outcome. I know that's a long-winded answer, but also wanted to address the collateral question that we had on the Q&A.
Yeah, so I actually want to dig into that a little bit more, Andre, because I know Anita had talked a little bit about the ESG and impact components for IDB, and then you talked about finding a lender that really has expertise. But is there any other key consideration that you think a startup or a company should make when selecting a venture debt lender that would be critical for their business?
Sorry. Go ahead. I apologize.
Sorry. I was sorry. Go ahead, Andre.
No. You go ahead.
Go later.
No, you go ahead.
No, I think, I mean, that's again to the point that why we partnered with Silicon Valley Bank. I think you need to be to find a venture debt holder that a lender, sorry, that has experience with this market, because again, it goes hand in hand with the venture capital market. So if somebody comes to you and say, oh, I've heard it. Okay, I've heard it myself. Oh, but what do you do? Oh no, I'm a venture debt house in the region. I said, oh, you are. So what are the funds you talk to? I mean, who are you talking to, right? What are the startups? And then you realize there is no such thing as talking to tech-based startups, nor with VC or private equity funds at all. So that is something else, not venture debt, right? It's that, and to me that's very important, because usually the venture debt lender is a lender that has the growth in mind, that just like the venture capitalist is going to help you go through the very challenging phases you have to go through to make your business grow. So it's more like a partner, and not by chance. I think we also partner with Partners for Growth. I think the name says it all. But precisely because of that, it's a different, the venture debt lender has a different mindset. As Andrea said, they are not it's not the incentive. It's expensive, it's time consuming. None of us want to do that. But because it's a bank and because of the regulation, etc., they ought to do so. So I just wanted to leave it here. I think it's important to know who that venture debt lender talks to in the ecosystem. I think that's very important.
May I add to that, Sarah?
Yeah, absolutely.
Yeah. So, so piggybacking on what Andre said as well, in terms of collateral, giving the lender collateral gives them, obviously a very serious position with the company. They have a lien on the assets of the business or whatever. It could be potential intellectual property, et cetera. And you need all that to obviously be able to run your business. So it's a very powerful right that the lender has in terms of having the collateral. And so, again, as Anita was saying, we're in times that are more challenging, right? Less predictable today. And for lenders that are just getting into the game, those that don't have as much experience yet, or other opportunistic lenders, we've seen family offices or, hey, I can do that too. And the thing that could be an absolute disaster is if a lender becomes very nervous at the wrong time as the company's going through, maybe a pivot or some changes to be able to keep up with the current environment. And again, that lender, because of that powerful right, can effectively put the business, cause the business to collapse. And so, making sure that you're working with a reputable lender that has a good track record and experience in doing this is something you should be looking for sure. In addition to the value add, as Anita was adding.
Yeah, can I just add something as well that I already saw in the market and that surprised me? And I said, well, I don't know what it is, but certainly doesn't look like venture debt, is when the lender starts to go after personal collateral. That is not typical of venture debt. If you go to a venture debt lender and the lender asks you for personal collateral, take a look, think twice. I think this is not what venture debt is all about. Anyway, I just wanted to say things. Now that we are talking, I'm remembering things that I saw in the last year that I think it's important to tell the audience.
Thank you, Anita. So actually kind of on this topic, Angie, so I know earlier we were talking about the fees and equity component, but can you talk a little bit more about SVB and what our process typically is for Latin American clients that are interested in venture debt as a form of financing? How should they reach out to us? What should they provide? All of that.
Right. Yeah, for sure. So making a distinction between Silicon Valley Bank, then our Latin Growth Lending Fund. So two separate entities. And first of all, we have the privileged position of working with many startups across Latin America. And so for any of our clients that are on the webinar today, feel free to reach out to your relationship manager here at the bank or anybody on my team. if you're interested in learning more about venture debt, and we are more than happy to then connect you over to our Latin Growth Lending Fund team. In terms of sort of process as we engage with our clients, there is a list of information that we typically will require. It goes towards, as you might imagine, financial statements, your business plan, your cap table, those kind of your go forward projections will be critical. Those things we'll be requesting of you to be able to take a look at and walk through any questions that we have, and then sort of connect you to our Latin Growth Lending Fund. And once they collect the information, by the way, they're going to ask for the same information, but if you're working through the bank, we will have provided that already to the fund. They'll have a longer list of information with more details as they look closer at the business, but that initial information will give them enough of a flavor to be able to, sort of have your initial conversations. And these days things can be done quite a bit through Zoom, but as the world's beginning to get back in person, I think both SVB as well as our Latin Growth Lending Fund team, our Partners for Growth team, will be in market to be able to meet with our clients and prospects as well on as it relates to venture debt.
Thank you. And my last question before we go to Q&A, actually, I'm going to put a little bookmark or a thumbs up for the ones that I think we've answered on the Q&A for everyone's reference. So I'm just going to go through them quickly. But the last question is for Andre. Can you talk a little bit about how you work with SVB and IDB from the legal perspective?
Absolutely. I mean, so for SVB, we started very early with them, and to Andy's point that I think SVB now, if not 90 or north of 95% of our clients actually bank with SVB and have a bank account to get money from institutional investors. And I think the way that the bank got there is through an easy process through KYC in terms of understanding the market information that is required from the founders and so forth. So they've been great partners. I think, Andy, during the pandemic, SVB was only of the few banks from the get-go that we were having issues with companies being issued tax ID numbers, and SVB literally worked with clients to be able to open bank accounts to some extent as permitted by law to give flexibility so people could get funded, because traditional banks were not opening bank accounts and the IRS was on lockdown here in the US, and that was a huge problem. So working with them and then with IDB on Anita's on the venture debt side and just pairing up whenever we have clients. We joke that we sell legal services, but at the end of the day, we also advise on networking and how they can reach out to the correct players to get the products that they need, being bank, being potential investors or potential partners of other clients that we have to be able to. And then in terms of what SVB and the considerations that people need to take, I think we talked about it. It's expertise. It is everything. It will save you money. It will give you something tailored to what you need. And you're going to be able to thrive better as a company when you have a partner next to you that understands what they are doing for the market that they're doing in. And then the last thing I would say is, because SVB and IDB are so embedded into the ecosystem in the US and LATAM specifically, I think also it gives you connections and access to other entrepreneurs that you need to talk to other investors that you need to talk to, so that you can start having those conversations earlier in the process when you're looking for your equity round after you did your venture financing or not. But if you're working with players that are there, I kid you not, it looks like a large ecosystem, but when you go to events and conferences, at the end of the day, you see the same people around. So knowing the people know how to connect you to those people that will be able to help you to me is everything in this market, so that it will help you grow.
Thank you, Andre, and thank you, Andy, Anita. I'm gonna go into the Q&A. There's some good questions that have come in. So this first one is for Andy, and obviously everyone else chime in. But I know that VC debt lenders don't have voting rights or take board seats, but what kind of input support does SVB offer to these companies?
So I think where the question is going, at least the way I interpreted it, is more around value add in terms of how, what else can we do besides providing capital? And so, and I think that's where Silicon Valley, over our near 40-year history, we work with, more than half of the venture-backed tech companies across the U.S. and 2/3 of the investors that support those companies. And so our network, our connections, in order to help you, make a key connection or to meet an investor or to, potentially access a new client, are things that that the bank is uniquely positioned to do vis-a-vis other more general banks. And then you layer on top of that our global gateway business. Again, that's been active in LATAM for over a decade, with the lens of really understanding what venture-backed companies from the region are looking for and how to work with them. I think it's a sort of a unique set of skills that we have to be able to be helpful to our clients and friends.
Thank you, Andy. There's a lot of questions that have come in around the terms of venture debt, and obviously there are some disappointing comments around people asking for personal collateral. But digging a little bit deeper into that, so I know, Andy, you had spoken earlier around 3 years is typically the range and all that, but is there anything else to add? So one of the questions was when looking at a venture debt facility, what are the usual terms, length of the loan that makes sense and when it doesn't? So anything on the con side of things when it doesn't make sense to look at or to use venture debt?
Yeah, I mean, this answer will be, I guess this is really more from the view of SVB and certain lenders around the notion of conversion is something that comes up quite frequently. Some venture debt lenders are happy to entertain the notion of a convertible loan, and some entrepreneurs say, hey, a venture debt is sort of like a safe note or something, or a convertible loan in general. Traditionally, those have not been, that's not the case, right? It's as I said in the beginning, the lender sees this as a senior loan that's to be repaid over a period of time, amortized over, over a 3 to 4 years time frame. And if you think about it, there are some banks that provide venture debt, very few, or one of the handful that do. Most of the venture debt players are funds, like our Latin Growth Lending Fund. It's like a VC fund or a private equity fund, but their product is venture debt. And when you look at the principal repayment, that cash coming back into the fund is something that a lender will recycle to be able to deploy to other loans. And so the more that you convert those loans into equity, that takes away from some of the cash flow coming in. So that would be one common misperception in terms of what venture debt is versus let's say a convertible loan. Does that answer your question, Sarah? Did I miss anything there?
Yeah. No, I think that's good. Another person asked if they can use venture debt to fund consumer loans at this moment in LATAM.
I mean, that's a very broad-based question, and I'm thinking, we're certainly doing and looking at warehouse financing for lending businesses in the region. And I would say that on the face of it, there's not a reason why we would exclude a consumer-focused business if it's a sensible business with a growing loan portfolio that's performing reasonably well. I think that could be considered for warehouse financing purposes. I mean, Anita was saying kind of earlier, I think it's more important today as you look at the macro environment with inflation increasing. How does how might all those things impact the performance of the loan portfolio? The more you got predictability, maybe if it's more of a a B2B type of lending scenario that might be a little bit less volatile than a consumer portfolio, just depending. So those kind of factors could come into play for a consumer business.
Thanks, Angie. And any color that we can provide around the range of interest rates? I know there's so much fluctuation right now, it's kind of hard to give much, but
It's like the million
yeah,
dollar
the other
question.
elephant.
Yeah. But I think I don't believe the interest rates are very different, right, Andy, of commercial lending. I don't think the advantage of the product is the pricing of the product. I think the advantage of the product is the flexibility of such. Is you are able again to complete your round at the value you wanted at the beginning without further dilution, and probably at a cheaper price than you would if you would do everything with equity. I mean, that's my personal take. Now, if you compare that to that, I think it's usually market rates. It's not, I don't see, right, Andy? I don't see big big differences, meaning lower or higher. It all depends on the business. It depends on the stage of the business, the sector of the business. But usually, fortunately or unfortunately, it doesn't differ a lot from what you see in commercial lending in your countries.
Said like an expert, Anita.
Yeah.
But I would only add that it's probably more expensive than if you went into the bank to get a overdraft or an invoice discounting loan. But the problem is that generally a lot of our scale-ups can't obtain those kind of loans in the first place from the bank. So it's not fair. It's not really an apples to apples comparison from that perspective. And the more appropriate comparison, as Anita pointed to, is, all right, what would I do? What would it cost me from a dilution perspective if I were to do this all by equity? And so then the venture debt pricing begins to look a lot more favorable. And I would say, just to give you some key just some high level things to think about, the fees, the warrants, so the equity component and the interest rate all play off of each other, right? If you're very sensitive to dilution, then maybe you pay a higher interest rate or a higher fee. The other way around is true as well. If you're more sensitive to interest and happy to give more equity, that could be another way to play it. But if you look at what venture lenders are aiming for in terms of returns in their overall performance, it's probably somewhere in the high teens to low 20s in terms of IRR to back to their shareholders. And so that begins to give you a sense of kind of how they would play it for constructing pricing on a venture loan.
And I think also to compare to the regular commercial loan, and we talked about this, but just to highlight it, it's the thinking behind the product as well. So if you go to your commercial bank, the bank really doesn't care about, right? It just wants the return. It wants the loan be paid out, and it's going to milk you on fees and interest rates. Again, obviously, venture debt is still debt, but the mentality of it all is that, and correct me, Andy and Anita, if I'm wrong, that the risk assessment that is done in the back end, right, to grant that loan is different than what your commercial bank is going to do. So to Andy, to your point that people don't get access to it because they're like, well, hold on, you don't have the numbers, right? You don't have that. And on the venture debt lender, they actually are looking for the company to be able to grow and potentially even get more or compensate with that little kicker of equity. And then just to clarify that point, Andy, for those that are listening to us and to what Anita said about dilution, even if on a venture debt you do have an equity component, it is, I don't want to say tiny, but it is compared to what you would have to give away on an equity financing, one, for the same amount of money, or two, what you would not be given in a commercial loan, but you would be, like I mentioned, be on the hook for the actual amount of the loan the bank's going to pull the plug on the loan at some point and say, hey, give me my money back. I think that is what makes the difference about this product, because you can play off each other and get a balance with a lender that understands the mentality of growth or venture-backed companies and tech companies in general.
Thank you, Andre. And I think one of the last questions, what are the key terms and covenants to look out for when negotiating with a fund? That might be an Andre question as well.
Sorry, can you repeat that? I apologize.
What are the key terms and covenants to look out for when negotiating with a fund?
Right. So I think it depends, and it goes to my point of expertise. I think the collateral is a huge one. And so to Anita's point, if you're on the hook personally and you're putting your family's assets on the line, that's a huge red flag. You should not take that loan. I think the negative covenants that we typically see what companies can or cannot do is obviously getting into more debt, right? Because that affects the ratio. Potentially paying out dividends. So anything that starts getting money out of the machine, if you will, of the circle to make the company grow, and it goes to investors first. So I think the mentality is the covenants you're going to get is to protect the investor in a way that their money is the first money out, always. Even prefer to be very clear, even before preferred holders are paid, the lender gets the benefit of that payment ahead of everyone else. So anything that you see on the parameters to control what's being used, it's going to be on your negative covenant. Now, on the flip side, I don't think you will see things that are absolutely outrageous in terms of how you're going to run your company. To a point that we had a question, there is no board seat. No one's going to opine on the direction that you're going to take on your company. It gives you the flexibility to do that. So as long as financially you're not basically withdrawing money from the business itself for other reasons, the negative covenants tend to be fairly slim depending on the product that you're doing and what you're negotiating with the bank.
Thank you, Andre. Oh,
If I
Andy,
can add,
yeah,
if I can just add, so Andre's 100% spot on in terms of when you get into the legal document negotiation there, lots of negative and affirmative covenants to be looking for. Oftentimes lenders will use some high level operating covenants to be able to track you against your plan that the lender is going to operate to. And so what might they be? They could be oftentimes it might look at what are you projecting for revenues over the next 18 months, for example, and then negotiating with you, some sort of discount towards that. So let's just make up a number and say, hey, we're going to track you to meeting 75% of your revenue plan, for example. Could be one way to do it, or it could be another. It could be a more bottom line focus where they would look at, what is your what losses are you predicting if you have losses, and then you'd say, all right, your maximum loss might be some percentage over that. So those might be some simple operating covenants that a lender would apply just to be able to make sure that the business wasn't really falling off a cliff, right? I think that's the main objective, and it gets back to the point of if you have an experienced lender, and if you get into difficult situations, sitting down with the lender and working through with them, hey, how do we get from point A to point B? You have that conversation. It's win-win on both sides. If otherwise, again, if with a more nervous lender, you may not have that kind of conversation.
Thank you, Andy. We are at the top of the hour, so we really killed it on this one. Thank you, Anita, Andre. Again, we love partnering with you guys, so really looking forward to the next one. If anyone from the audience has any questions, we will make sure this in the recording afterwards and everyone's contact information, so feel free to give any of us a shout if there's something that you wanted to ask and didn't have time to or just didn't get answered. But yeah, very much looking forward to our next event, and enjoy the rest of your afternoons. Thank you.
Thank you, Sarah. Thank you, everybody.
Thanks
Bye.
everybody for joining.
Take care.
Bye, everyone.
Thank
Thank you very
Ciao,
much for
ciao.
joining.
Ciao.
Bye.